All right, so more people have filtered in and they continue to filter in, but we're going to get started today because we like to stay on time. And we thank everyone for taking the time to join us today. And so, what happened was recently we put together an investment insight called Everything You Need to Know About Diversification. And so, you may have read that. If you haven't had a chance to read it, encourage you to do so. If you don't have it, let us know and we can send it to you, but you can find it on the Prudent Speculator website there. And so encourage you to take a look at that. A lot of interesting facts and figures in that paper. But what it did was it spurred an idea to have a webinar because we haven't had one here in a few months. And also a topic that we'd heard a lot from clients and prospective clients around dividends and the power of dividends and even the diversification benefits of dividends. And so we decided to kind of put that together into one presentation. And we weren't very clever, just dividends and diversification. John's going to go through some slides he's put together. It's kind of how we normally do this. He'll do a presentation for probably about 25, 30 minutes. And then after that, we'll do a Q&A. And so at the bottom of your screen, you'll see the little Q&A logo. If you click on that, you can enter any questions, and then we'll take those all in. We'll try to put together the ones that are similar, and then we'll just go through a Q&A session where we can answer them. And so you can ask questions about the presentation, current market, maybe other things that we might be doing. You're welcome to answer questions about our wealth management strategies and services, about the newsletter. We encourage all of those questions. And then I'll say it again before we start. If we get a lot of questions, as we often do, and there are any that we don't answer live here on the webinar, we will follow up with you individually, or we'll post them to the blog on the TPS website so that everybody can see those additional questions and answers. And so with that, John, I'm going to hand it over to you. I'm going to mute myself, and we look forward to hearing what you've got to say about dividends and diversification.
Well, great. Thanks, Jason, and thanks everybody for taking part in the webinar today. It has been a few months, and the markets have obviously been volatile, as is often the case. Good volatility, and here in the last week or so, quote unquote, the bad kind of volatility. So, we always like to talk about our team approach. I'm the guy who does the spiels here, and obviously Jason is our host. But we have two other folks on the investment team, including Zach Tart and Chris Quigley. Chris is our primary number cruncher, and he's the guy who put together the diversification report and did all of the math behind that. And essentially, what Chris found was that what we've done all along in terms of liking broad portfolio diversification is supported by the data and the math and the historical evidence. So, for those who aren't familiar with us, we do publish the Prudent Speculator newsletter. We put out a lot of content, our weekly market commentaries. Obviously we value feedback from our readers. Many of the folks on this webinar, of course, are subscribers or familiar with us. And so, we always are looking for ways to deliver information in a interesting way and get materials out to folks. So we welcome questions about what we're doing and why. And a lot of that serves as the foundation of the special reports we do, or we'll talk about it in the market commentary. And we just think there's a whole lot more than just the monthly newsletter that we provide to our clients. And part of the reason we do all of this is to show you that a lot of what has happened or is happening today has happened before. Historically speaking, we've seen markets go through ups and downs, and generally the long-term trend is up, as you can see on the screen here. Those pinkish bars are bear markets. We've had 27 quote unquote official bear markets since over the last 100 years. And we had an unofficial bear market this year, that we did actually have a 20% intraday move down, which is the definition of a bear market. We just didn't close down 20%. So, for many people, it doesn't count. And of course, I like the joke, well, why would you count, a bear market when the market is open? You only want to count it when it's closed, which is crazy because people often will have, say, a stop loss order or something like that in place. And if you truly had something in there and said, I can't stomach, volatility more than 20% down, Well, you were stopped out on April 8th and April 7th. Both days we saw markets, at least the S&P 500, down 20%. So we do like to provide perspective. There's been a lot of obviously bad stuff that has happened in this country over the last century, but yet the markets reward those who take a long-term view. As Warren Buffett says, he thanks his lucky stars he was born in the United States, despite all of the problems. And obviously, we're in a very polarized, country these days. And so people are either you don't like the current administration, you do like the current administration. But no matter what has happened, equities over the long term have appreciated and rewarded those who stick with them. The challenge, of course, is in sticking with them. And that's where diversification, and we think focusing on dividends adds great value, no pun intended, because we are value investors. John Rockefeller said, "Do you know the only thing that gives me pleasure? It's to see my dividends coming in." Obviously, a very wealthy man. We hope he had more pleasure in life than just dividends. But there is something to be said about those payments that you get. On the screen here, I'm just showing you TPS portfolio, which is the model portfolio for our newsletter. It's Al Frank's family portfolio. Al Frank, the founder of our newsletter, passed away in 2002, but we still manage the portfolio for his family. And just in the last month, the stream of dividends totaled about $11,000. Now it's a $5 million portfolio, so 11,000 isn't the greatest number when you're talking about a big value of an account. But it does provide comfort and I think peace of mind for investors to focus on the income stream they're getting. If you think about, say, a rental property that you might own, what you care about is the rent. You don't really care so much about the daily fluctuations of value of the property, because at the end of the day, you're not a seller today. So our focus is always on the long term. We're not sellers of any of these stocks today. So what they do on a daily basis, while certainly important to looking at the overall value of your account, what really matters is the account generating, in our thinking anyways, the income that you might need to help you achieve your long-term investment objectives. And so to look at those, if you're looking at your portfolio, excuse me, on a daily basis, you might just look at the value of the account. But we always encourage you, if you're going online, to look at those transactions, especially if you own a portfolio like ours where you have the dividends coming in. So it can be very reassuring when markets go through their fluctuations. And over time, those dividends have increased. That's one of the things I think investors forget. And so we have show you the numbers here on the S&P 500. Over each year, generally speaking, most companies, about 2/3 of them, will raise their dividends. Obviously, there will be a handful that reduce them or suspend them. But over time, dividend payouts increase. And you can see on this the chart in this middle of the screen how the payout on the S&P 500 has risen over time. And then if you look at TPS portfolio, and that account has had money withdrawn out of the portfolio, and yet the dividend payments have doubled over the last 10 years. So dividends can be very valuable and are certainly a significant component of total return. And dividends grow over time because corporate profits grow over time. Those green bars are showing you the trend in the S&P 500 and of the earnings per share. And we're likely to see, as we go forward over the next year or two, earnings are expected to continue to grow. So companies have the wherewithal to pay dividends and to increase their dividends because, generally speaking, over time, their profits grow. The other piece of the puzzle, in addition to, we think, providing you some sleep at night value via dividend-paying stocks, is that historically speaking, dividend payers have outperformed non-dividend paying stocks. Now, the gap is not huge. It's anywhere from 10 to 11% to 9% for non-dividend paying stocks. But obviously, over time, that difference will compound significantly. So you can get higher returns from dividend paying stocks and have the the peace of mind and maybe, and the income that you might need to pay the bills, along the way, instead of simply relying on capital appreciation. Now, over time, again, that other chart showed you dividend payers had outperformed over the long haul. But even over, say, the last 20 years, dividend paying stocks have beaten non-dividend paying stocks through the end of September of this year, and 30 years and 40 and 50 and since inception of the data series. So dividend paying stocks, in our thinking anyways, have been the place to be. Now, these numbers are on an equal weighted basis, so we don't have capitalization weighted figures. But again, we are not out there investing, 7% in NVIDIA and 0.0001% in a small cap stock because we're trying to be cap weighted. Generally speaking, we are equal weight investors. So we think this data is very germane. And not only does it show that value stocks beat growth, but it also shows that dividend payers beat non-dividend payers. And perhaps even more interesting is that dividend paying stocks have had lower volatility, lower standard deviation, or as some people equate standard deviation to risk. So, dividend payers have higher returns and lower volatility, which is kind of the holy grail of investing. And I know it's hard to see on this chart, but the little dots are showing, dividend paying stocks, standard deviation, and non-dividend paying stocks are the lower line there because they have lower standard deviation. And we're not the only ones who noticed this. Here a few months ago, the Wall Street Journal had a piece that said investors are right to love dividends. Again, this is looking at things on an equal weighted basis. But again, even if you don't go back to the 1920s as we did in our study, this goes back to 1973 through the end of 2024. So 50 years of data showed that dividend paying stocks had higher returns and had lower volatility. So others have confirmed what we have found. And again, we think that's an important part of helping investors stay on their long-term path is having a portfolio of stocks that may not be as volatile as the overall quote unquote market. Again, the idea is that you want to keep at it and not get scared out of things when markets go south. Now, today, we also are in an environment where the Federal Reserve is lowering interest rates, which historically speaking has obviously made, shouldn't say obviously, but it has made dividends more attractive. Lower interest rates on fixed income investments is less competition for dividend paying stocks. And so we've looked at the market history when the Fed is lowering interest rates, and how have dividend payers performed versus non-dividend payers, how has value performed versus growth. And these charts on the left will show you that when the Fed funds rate is falling, it's been a better environment for stocks in general, been a good environment for dividend payers. It doesn't mean that if rates are going up, it's bad for stocks. It's just less good. But stocks historically have done better when the Fed is friendly. And so we are in that environment, although we don't know when the next Fed rate cut will be. But expectations are that there will be several of them going forward, which again, history is just the guide, not the gospel. But over time, dividend paying stocks have done very well, especially relative to non-dividend paying stocks when the Fed is being friendly. All of this is leading up to one of my favorite sayings by Lao Tzu: if you do not change direction, you may end up where you're heading. And this is the reason that we focus this presentation on dividend payers, because again, they are less volatile, they do provide income, and again, on the equity side, they give you the outperformance. But it's not just about buying a handful of stocks. We think that when you think about diversification, we want to think about the overall pie, the overall, asset allocation mix. And of course, that's going to start for us with the equity side. So one of the things that Chris Quigley wanted to study was to look at the amount of stocks that we hold in our portfolios, because we do believe in broad diversification. We hold something on the order of 70 to 90 stocks in our managed account strategies. And there's a reason for that. Of course, we don't know which of our stocks are going to be the home runs. And we go back and look at Apple, for example. We talked about this in the report. But if you go back and look at Apple, when we first bought it in the year 2000, we have a 65,000% gain or so on the stock since then. But it wasn't one of our top 10 stocks or top 20 stocks then. Only with the benefit of hindsight could we have said, well, that was clearly the stock to buy back then. So we've always believed that buying a broad basket of stocks makes sense. Now, there have been academic studies done that have confirmed this, including one by a fellow named Myers Statman back in the early 2000s. And that one suggested you might need 100 stocks. That would be the ideal number in a portfolio to really get the best bang for your buck and to limit risk and still have the best chance for a return. So what Chris Quigley did on our team is he crunched numbers and looked at various portfolio sizes. Now, these are randomly assembled and did 100,000 simulated portfolios with 5 stocks, with 10 stocks, with 50 stocks, and 100 stocks. And what he found was that the more stocks you had, the better the return you had, and the better return per unit of risk that you had. So you got rewarded by having more stocks, by having a higher return, and I don't want to say lower risk necessarily than the other ones, but for the higher return you got, you didn't have to take much more risk. And so, the standard deviation was, as you can see in the text there, a 50 stock portfolio was 23.4, 100 stock was 21.1. So in reality, you had a little less risk and a little higher return when you had more stocks in the portfolio. So again, there's historical data that supports having broad diversification in an equity portfolio. There's our own number crunching. And what we've done is that we've, over time, as our level of technological prowess has grown, we've been able to kind of confirm and verify a lot of the things that Al Frank thought when he first started off doing this in 1977. Al thought that value stocks made sense to him because he was a frugal fellow and a bargain hunter by trade. And oh, by the way, they've outperformed growth stocks over the long haul. He thought that holding stocks for the long term made a lot of sense. And the longer you hold, the lower the chance of loss, we've found. And he believed that broad diversification made a lot of sense too, and started talking about this way back in the late 1970s. And so happily, the number crunching we've done has validated and confirmed, what we believed all along. So when you look at an equity portfolio, there is real logic that supports, having a broadly diversified account. And as I say, we like to see 70 to 90 in our diversified portfolios for our managed account strategies. I think Buckingham portfolio has a few more stocks in it right now than that because money's been added over the years. But that's, we think, is a good number to have. Now, Chris also did analytics on an asset allocation approach as if you had an 80-20 portfolio. We also did 60-40, and all those data are in the report. But again, confirming even with you just went off toward ETFs or indexes for the equity exposure. We got the same kind of results. The more equity exposure or the more diversification you had in your equity exposure, the little better return that you got. And it didn't really matter because we looked at the fixed income side too and said, well, does it matter if you have a broadly diversified fixed income exposure? And it didn't skew the numbers much at all. What skewed the numbers was having more equity exposure. So again, diversification we think is very important to help keep people on their path, to help mitigate risk and volatility. And historical studies have confirmed that it does add value to have more equity holdings than less equity holdings. Now, we also know that over time, we don't know what is going to be the top performing asset class. We utilize this. We have our dynamic portfolio strategy that Jason and Chris run. And that strategy, has different asset classes associated with it. And the idea behind that, again, is to help mitigate the volatility that you're going to see by simply being all in equities. And as this chart shows, 1 year, cash, of course, was a great investment in 2022. Emerging markets have been fantastic this year. It's been a fantastic year for international stocks. But in the years past, international stocks were more, toward the bottom or the middle of the list. So over time, again, asset allocation is super important, because you're just not going to always have, top of table performance by simply being in, say, large cap equities. So we do believe, for those whose portfolios we manage, because many of our clients utilize us to manage their whole pie, not just their equity pie, that having a diverse mix of assets is going to help them to achieve their goals, and do so with an ability to sleep better at night. And part of the issue for investors, hopefully not ours, because they've read all of our stuff and they're willing to ride through the ups and downs, as we always have been. But over time, investors have a lousy market timing ability. They tend to get too emotional about it, and they'll pile into stocks when markets have run up. They'll panic after markets have gone down. And every year we look at the Dalbar study, the quantitative analysis of investor behavior, QAIB, and it is fascinating to see, the investor returns versus the index returns. And it's not that the mutual funds that are studied in this are awful. It's the timing of when the monies flow into those funds and when they flow out of the funds. And it's even worse on the fixed income side. That's what I've always been fascinated by when I look at the Dalbar numbers, is if you look at, the fourth column of numbers there, the average fund investor return for every period, fixed income investors have lost money on average. This is always on average. I've lost money for every period by investing in bond funds. And again, it's fascinating, hard to believe. And obviously it suggests that the average investor probably shouldn't be investing in bonds, because they don't have the mindset or the discipline to be able to enjoy the returns that bonds provide. Because again, over 30 years, the aggregate U.S. bond return has been 4.6%. Yet the average fixed income fund investor had a 0% return over that time. So having the ability to navigate the ups and downs, ride through, all of the volatility you're going to see is 95% of the game, because so many investors shoot themselves in the foot by, panicking in April of this year, the Liberation Day tariffs, go back to, the pandemic. Every year there seems to be something, about which to worry. And yet over time, those who keep the faith and stay on course, have achieved, fantastic long-term returns. And so part of what helps us to keep calm and, not be nervous about some of the things that are causing investors consternation today is that the valuations on our portfolios are reasonable. We hear talk about how the S&P 500 is, trading at levels not quite as where it was in the year 2000 or the tech bubble. But it certainly is richly priced at 28 times forward earnings or so, or 28 times trailing earnings, 25 times forward earnings. And dividend yields on the S&P 500 are low. 1.2% is low by historical standards. So you have a high valuation metric on earnings. You have low dividend yields. So I understand why people would be concerned about investing in the index. Happily, we don't have to invest in the index. And you can see our PE ratios, the second set of columns there, the forward PE on TPS portfolio is 15.4. The dividend yield is 2.2%. Now I know 2.2 isn't great, but it's a whole percentage point higher than what you're getting on the S&P. And so this allows us to sleep well at night. Yes, it's been a fantastic year for our strategies. We benefited mightily from our AI exposure. And as readers know, we've been chipping away at many of those stocks as they become much more expensive. But there's also a universe of stocks out there that hasn't participated or hasn't moved up in the level that we think they should. So there's a lot of value still left in the market if you can get outside of some of the mega cap technology names. And of course, we do own Apple, and we own Meta, and we own Alphabet, and we own Microsoft, we own Broadcom. So we do own, a chunk of the top names out there, but we certainly don't own them in the size that they are in the indexes. And of course, when we bought them, we were buying them when they were very much value stocks, and we've been willing to hold them as they've moved into the growth at a reasonable price category, which is where we think they still reside. So with that kind of as a caveat or an intro, because we know people like stock picks. Now I only put 30 up here, and you should have, as I say, we should have 70 to 90. But we took the stocks we're recommending. We looked at valuations to do some screening, and then we looked at dividend yields as the primary component here to see, and every stock that's on this list has a yield of at least 2.5% or more. So as we think about the theme here, which is diversification, usually we don't show 30 stocks. We know that's a lot for people to digest in one webinar. But we do believe, again, that having this diversification, having a focus on reasonably priced and even inexpensive stocks. I mean, if you look at some of those, forward PE on, Bristol Myers is 8, Civitas is 6, Comcast is less than 7. And you can see the big dividend yields that are available on those as well. And so, it's important when you think about, investing to consider the total return, because it's not just about did the stock go up or not. You get a significant income part of the equation into the total return calculation. So you can have, names like we have Verizon on here, which, quote unquote, hasn't done much, over the last, half decade or decade. But if you're getting a 6+% yield and modest capital appreciation in the process, you can have a very nice total return. And so that's what we think is important, that investors keep in mind, that it's not just I bought it at X and it's trading at Y. It's what have I also achieved in terms of the income out of the investment. And so I think this is a nice mix of stocks. Many of them are down on the year, which, again, people say, why do you want to invest in something that's gone down? And I say, yes, I do want to buy things that are on sale. That's what a value investor is looking for. Now, of course, a couple of them are up. CVS is up 82% this year, and it would have been on a list like this last year. Because again, we think that there's opportunity for these businesses to continue to grow their bottom line, but also to get a higher valuation multiple. And that's, I think, is part of the equation. When you invest in value stocks, you do still want the businesses to grow, but you also want the market to revalue the stocks higher. And that's really been what has happened this year for our AI related stocks, is that yes, earnings have grown, but also the multiple that investors have been willing to pay for those earnings has increased dramatically. So that's why we have like a name like Seagate, the disk drive maker, which is up 200% this year. It's not that business is up, of course, and earnings have grown, but earnings haven't grown 200%. The multiple that people are willing to pay has grown. So we think that most of these stocks are trading below where they should be trading in terms of earnings, and or their earnings are temporarily depressed and are likely to ratchet higher as the economy moves through its various cycles. So we like having the broad mix of stocks. We like having the yield and the income stream. And we think that equities should be a significant component of any asset allocation mix. But we also respect that man does not live by stocks alone. So again, we offer for our clients, asset allocation portfolios, and that include alternative investments, fixed income, and international stocks. And so there's a whole gamut of what we can offer, but we obviously understand that the prudent speculator folks are interested in stocks. And so I'm going to put my disclosure slide up there so you all can read it. And make sure that you've studied it all. And then I'll put the stock picks back up, and then I'm going to turn it back over to Jason for questions.
Thank you, John. I'm proud of you. I started a little bit late, a minute or two late to let people came in. I told you 30 minutes, and you actually got it. So fantastic. Before we get into the Q&A, we've had some questions come in. Want to remind you down at the bottom of the screen, you see the little Q&A icon. You can click on that in submit your question, and we'll try to address each and every one of them. If we don't get to all of them, then again, we will post those answers to the blog on the Prudent Speculator website. And if for some reason it's more of a personal type question, then we'll reach out to you specifically. John, one of the things that I wanted to start off with on valuation stuff, and you had it on the slide around our portfolios and indexes, but just talk a little bit about the gap and why you're optimistic, the gap between value and growth that we're seeing. And then bigger than that, I think even is the gap between small and large domestically and on those valuations, and why we see opportunity in both that small mid value space as well as just value in general.
Yeah, well, it's a very good question, because as we say, it's a market of stocks and not simply a stock market, right? And this year we've been in an environment where it's the haves and the have-nots. As I go back to this slide, you can see in the year-to-date total return column, there's a lot of double-digit losers this year. So I think that we have a situation where investors have piled in perhaps too aggressively into the growthier part of the market. And so the valuation gap, if you look at the multiples here, you look at like the Russell 3000 growth index trading at 35 times forward earnings, Russell 3000 value at 19 times forward earnings. Now, growth is always going to be more expensive than value, but the differences between the norms, value stocks are trading a smidge above the norm over the last 30 years, whereas growth stocks are trading well above their norm over the last 30 years. Doesn't mean that they can't continue to grow. And we are, to be candid, riding some of the momentum, at Microsoft, Apple, Alphabet, a lot of these names, Seagate, even a company called Lumentum. We've been riding the momentum in Lumentum, and we're comfortable continuing to do that. Because we do understand that the AI infatuation is unlikely to go away. We'll see what happens after the close today with the NVIDIA now earnings and conference call. But we think that there's still significant upside potential in those stocks. But we also understand that there's also a lot of downside volatility or risk. Those who follow the newsletter know that we own Oracle. Well, Oracle had earnings out, a couple months ago, and the stock went up some ridiculous amount, $80 or $90 in a day. We ended up taking some money off the table. Now, happily, that was at $100 or so higher than where it is today. And Oracle's still a great company, still going to benefit, we think, from AI, trends. But the stock price has come down dramatically, and so we think it's prudent to be taking money off the table on some of the expensive stuff, which then gives us dry powder to plow back into some of the inexpensive stuff and start that process over again. And that gap between the expensive and the cheap is super wide. And Jason mentioned, small cap. You can see on there the small mid dividend value. We're 11 times forward earnings on our SMID strategy, and the dividend yield is 2.8%. So there's great opportunity, we think, in the areas of the market that have been left behind. And some will say, yeah, but it's always going to be that way. It's never going to change. And I can say, well, we respect your opinion, but you might want to look at the international equity markets this year, because international stocks had been, laggards for a number of years. And all of a sudden this year, they're up dramatically, returns in the 25% range on our international strategy. So, just because something hasn't performed well for a number of years doesn't mean you should avoid it. And the nice thing, when we think about value, and I put this chart in the market commentaries, is that value's done fine. We've had good returns, but the returns haven't been off the charts on value. If you look back over the last 10 and 20 years, the value indexes are actually, from a return standpoint, still, while very good, are below what they've done historically. Value stocks have returned 13% a year. So this idea that the market, quote unquote, is overvalued and due for a crash is missing the point that we're not investing in the market. We're investing in individual stocks. And we saw this when the tech bubble burst in the year 2000. We had a lot of tech names, and yet, we still made, 5% or so in the year 2000, and we made, 30% in the year 2001, even though the S&P 500 was down. Now, no guarantees, of course, that we repeat that if we do have another tech implosion. But it does show you that it is a market of stocks, and simply because the S&P 500 may be richly priced doesn't mean there aren't areas that are inexpensive, and we're going to target those areas for our new investments.
I appreciate you saying that, John. Yeah, because we hear the talking heads on the TV, and obviously there's a lot of write up in the media and now on social media. They talk about the expensiveness of the market, and as you pointed out, there are lots of pockets, there are lots of sectors, industries, or just companies in general that are out of favor, unloved, or maybe have taken a hit. And so there's long-term opportunity, and that's what I think we always like to focus in on is long-term. Now that you've got the list up, we've got more questions coming in. I want to remind people down at the bottom of the screen, you've got the Q&A icon. Submit your questions. We're going to get to as many as we can. We'll put the rest on the blog. And so we had a couple of questions just in here, and one of them I know you're going to love. It was almost like I wrote it, but I did not. It's actually from somebody who's been listening today. He said, of the 30 stocks shown, most have a negative return year to date despite the strong market. Isn't that concerning? And so talk a little bit, I know why you did this, but talk a little bit about why you offered up most of the stocks. If everybody's looking at the screen, you're going to see there's a negative number on the year-to-date total return. So I'm going to let you touch on that for just a minute or two.
I only have a minute or two.
Yeah, I'm going to cut you short.
I could have done a list and shown you, Lumentum and Seagate and Eaton and Caterpillar and Broadcom and all of the things that have done extraordinarily well for us. And our returns have been fantastic this year. So what we think is a better service for those who are listening today is which seeds, if you will, have yet to sprout. I know many investors want to chase after the hot stock, but I'd rather be investing in the things that haven't had their day in the sun. Because again, the Broadcoms, the Seagates, the Lumentums, those were all stocks that at one point were just like these.
They would have been on the list.
Lumentum is a perfect example of that. I think we recommended it at $70 or $80 and watched it go to 40 or 50. And they're a maker of optical components. All of a sudden now they're, AI picks and shovels play. And, we keep whacking it back because, when it got to 200 and 220 and 240, when we bought more of it in the 50 range or so, we bought it because it was down. And that's just how our thinking is. We want to buy things that are on sale. It's the value investing mindset. So, something will always attract me when it's declined in price versus when it's risen in price. And again, we have 120 stocks or so. These are 30. And I could very well, and sometimes I do, I'll show you the things that have gone up a lot. But of course, compliance likes it when we're honest. And we show the losers as well as the winners. And some of these, we just recommend it. We're not down 30% on Accenture. It's a recent recommendation. Wendy's was a recent recommendation. And we bought them because they've been beaten up. And we have another new recommendation coming, next month in the newsletter of a stock that has been hit hard. So again, it's a market of stocks. We think investors should be looking at individual stocks. I was going to add to the last comment about, if you watch CNBC, one of the concerns they'll say, well, gee, if the Mag 7 doesn't do well, how can the market do well? Well, it's math, because the Magnificent Seven is a massive component of the S&P 500. And if the S&P 500 is your definition of the market, well, guess what? The S&P 500 is going to get whacked if the Mag 7 get whacked. It's just math. Now, yes, the rest of the 493 stocks could all go up, and maybe they could overcome it. But generally speaking, if you're investing in the quote unquote market, you are investing in a, and if you're investing in the S&P 500 or the NASDAQ or something like that, you are massively exposed to, some of the AI trends, which is great. Nothing wrong with that, of course, here this year, but you have to understand that your risk, you have a lot of eggs in that one basket. And we just think as you take some of the eggs out of those basket or harvest some of the crop, you should be replanting in more undervalued stocks. And that's what we're doing.
But on that, John, I'm going to jump in there because we had another question that was talking about this idea of diversification and dividends and diversification through dividend payers. And so the question, because I kind of want to read it, that's why I'm looking over this way. Do you think a dividend diversification strategy for a portion of one's portfolio might be met or best met or used to use a dividend ETF versus individual stocks? And I think some of it obviously can go back to what you were saying, how it depends how it's weighted. Is it equal weighted, or are we going to be all like skewed towards the largest cap? Is it going to be market cap? So talk maybe just a little bit about that also.
Well, that's a great question about, indexes. You want to understand what your index actually, how it's actually constructed, because the majority of indexes are capitalization weighted, meaning that the largest components are what drives the index. And the smaller stocks really have no impact. That's why I said, well, gee, if the Magnificent Seven, does poorly, the S&P 500 is likely to do poorly, even if the other 493 stocks, manage to tread water or go up a little bit. So it's, the question is, what's a better way to approach it? I like individual stocks because I like the granularity to be able to say, no, I prefer this company over that company. But there's nothing wrong with looking toward an equal weighted. I would focus on equal weight. If there were a dividend-oriented equal weight strategy, I would be focused on that. You also have to keep in mind that even on the value side of the equation, there is concentration. You're going to have most of those indexes will have Berkshire Hathaway, JP Morgan. We like JP Morgan. We're not big fans of the valuation of Berkshire Hathaway, but you're going to be making big bets if you're in a capitalization weighted index. So personally, I like individual stocks because I want to invest in things that I think have great capital appreciation potential in addition to the dividends. But if you want to set it and forget it, so to speak, you don't want to do the work, well, obviously we can manage your money for you if you wanted that, but you could also buy a dividend-oriented ETF.
All right. So many questions. I'm hoping we got time to get to a few more here. Another question. What is your thinking for retired people on reducing fixed income allocation in favor of dividend growth stocks? And before I let you go off on that, I mean, obviously that is going to depend on a person's individual situation, and even get past all the buzz phrases of risk tolerance and time horizon. It does come down to your cash needs, to a portion of your allocation that you're going to need to potentially keep steady. That's one of the things with our team and our company, the way we view fixed income, right? It's a diversifier, it's a ballast. We look at it as ballast. We're not trying to get an extra little inch out of the performance in fixed income to enhance the portfolio return. We're looking for ballast. We're looking for diversification. We're looking for income generation. But John, your thoughts just a little bit on that, whatever I didn't throw in there on making the shift.
Yeah, you pretty much covered most of it, but age is just one component of this. What really comes down to is, when do you need your money or your income stream and how best to achieve that. And also your tolerance or comfort with volatility. Because, today, we're sitting here and I don't know where the market is, it gyrates all over the place. I haven't looked in the last, 45 minutes, but we're, for some, we've had a 4 or 5% pullback. And for many investors, that's like the end of the world. And, historically speaking, we get 3-5% pullbacks a year. We get a 10% correction, every 11 months, if you look at market history. So, volatility is always going to be there. So it all depends, really on how you're wired. But most importantly, and this is the work we do, is to try to evaluate, well, when do you need your money? And for many investors, happily, they have their income needs covered via pensions, rental income, those sorts of things. And they're investing not necessarily for themselves, but next generation or even the generation after that. So they can be much more heavily in risk assets. I shouldn't say riskier, risk assets like stocks. But as Jason says, it all starts by doing a thorough evaluation of your financial situation. And we can't make a blanket statement that you should just dump your bonds and be in dividend paying stocks, because that doesn't incorporate all of the facts you would need to make that decision. But generally speaking, for an individual, they should really try to understand when they need their money, because the majority of folks, my personal view is that people have become far too conservative too early in life, given life expectancies and how long your money needs to last. And so yes, you might need 3% of your portfolio or 4% of your portfolio every year. Well, we can build you a diversified portfolio that might include some fixed income that will allow you to achieve that without tapping into principal over time. And so that's why I think a good financial planning and retirement projection process is important, and we do that for our managed account clients. And we certainly, anybody listening on this who'd like to have us manage their money, we'd be happy to do that for them as well.
Yeah, I appreciate you saying that, John. Yeah, that is one of the ways, right? We everything starts with a financial plan and a cash flow analysis. So as we get wealth management clients in, that's where it all starts. We look at all that, and then as a partner to that person, then we make allocation decisions jointly with them, and trying to align to goals, whether they be near term or long term, and that kind of just brings out what the allocation should be, and it'll drive that how much should be in stocks, how much should be in bonds, alternatives, and then there's obviously going to be personal preference too. Now on this question, I'm going to try to combine a couple of them. So if I just let you go, we're going to run out of time. So I'm going to cap you on your time on your answer. But a couple of questions, one and just a stock specific, we'll get into that. What are your thoughts on the potential Civitas, so CIVI SM proposed merger? Will it strengthen CIVI's ability to operate through potential downturn in the oil market? And then with that, we also had a question, and I apologize to everyone. I'm looking over because the questions are coming up on the other side. Why do you not have more energy stocks on your list, seeing that their yields are high? And so I know that's two very separate, but since we're in the energy space, talk a little bit about the potential CIVI SM merger, because we've been doing some work on that. And then talk about energy stocks, why there aren't more on the list, and maybe you can mention a couple more that we like.
Yeah, well, to take the second part of that, we do like energy stocks. I want a diversified mix. If you look at the overall weighting in our portfolio for energy, it's 4 to 5%. So having two stocks here, we chose Chevron and Civitas. We think that was the right amount in terms of the number of stocks that were being selected here. But we also like in the exploration and production area, EOG Resources, ticker symbol EOG, Devon, ticker symbol DVN, David Victor Nancy. We like Exxon in the major integrateds. We like Total, the French company. So there certainly are a lot of opportunities within energy. Now, Civitas is interesting. They are merging. It's a merger of equals. We will be, it's going to take a little while. So we are studying the merger. We think there are going to be some synergies there. And so we think the merger is going to be a positive, but we'll keep folks apprised of what we're going to do, because we do know Civitas has an unrealized loss, and in a year where substantial gains have been taken, on many of our stocks, we can always use a loss or two here or there, and there might be a way to swap out of Civitas and into SM. But we're still evaluating that, and for now we still like Civitas very much, and we liked it as a standalone. We don't see it as a negative merger, especially a merger of equals. And so I definitely, if you're looking at names to buy, I'd still be in favor of buying Civitas today, but don't be surprised if we ended up swapping into SM, and then of course we get the combined company once the merger goes through.
All right, thank you. Got a lot more questions coming in. I know we're not going to be able to get to all of them. One of the things I want to touch on, we've had a number of questions come in about our wealth management strategies and services, and so that's more of an individualized response, I think. And so what we're going to say here is, if you've got a question, you'd like to have a conversation, info@theprudentspeculator.com. Info@theprudentspeculator.com. That's an easy one to remember, or you can email me directly, jclark, JCLARK, at Kovitz, KOVITZ.com, or you can call me directly, 949-330-0901, 949-330-0901. So all of you that put in questions about wealth management strategies and services, reach out in one of those three ways. If you put your name in, we can maybe directly reach out to you. If you did anonymous, we can't. So around all of that individual wealth management strategy and service questions, the things we do, the process, fees, assets required, we'll just have a one-on-one conversation about those things. John, a couple more questions as we've got 7 or 8 minutes left here. There are a few REITs on the list. Can you comment on why it might be an opportune time to consider adding REITs or adding to the REITs that have been hit pretty hard? Just talk in general about that.
Yeah, well, REITs, of course, are different animals in that you're valuing them on funds from operations and not a quote unquote PE. I know we're showing a PE number here, but that is really price to funds from operations. So many REITs have been hit hard. It's kind of a head scratcher, as they often tend to be interest rate sensitive. So lower rates would mean that investors might gravitate toward REITs. We have Alexandria on here, which we still think is a best in class. Now, of course, their real estate focus is on medical, so labs, lab space, and with the government shutdown, that certainly didn't help them. And the FDA wonkiness. There's slower approval time, so there have been some headwinds, but we don't think that the stock price should be down as much as it is. Plus, of course, the last earnings announcement, management indicated that the funds from operations will be a little lower next year in all likelihood, not a lot lower, but a little lower, and that the dividend will be looked at. So you can see the yield there is 10.4%. That's the trailing basis going forward. That might come down. We don't think it'll be whacked dramatically because REITs have to distribute 95% of their funds or their income out to investors. And so the yield might drop to 9%, something like that, but we still think that there's great opportunity in the REIT space. And again, the primary reason is that these have, generally speaking, been poor performers this year in an environment where, in theory, they should be good performers. Again, Fed cutting interest rates should be a positive for interest-sensitive stocks. Now, we'll see what happens with actual rates, because, again, the Fed cut rates here recently, and the yield on the 10-year Treasury has gone up a smidge since then. But rates have come down from where they were, and we do think that REITs are a good place for investors to be. I think you're going to get capital appreciation and the big dividend payout.
All right, we had some questions here about international stocks, and I know we do like some international stocks that pay pretty good dividends. And so let's talk a little bit about that, and let me just kind of fold in some questions. One of the questions comes around, should I invest in the international stocks directly, the U.S. traded version, or just stay with U.S. stocks? There are also some questions around international dividend ETFs. And I think our response around the ETFs are going to be the same thing. Understand the components within the ETF, like what's in there, and then understand the weighting. Because again, if it gets weighted in one of our international strategies, we use direct country ETFs. And so we've really got to pay attention to what the components are, because sometimes you can, because they're cap weighted, one stock could be 15 or 20% of that ETF. So you want to drill down into that information to make sure you understand that you're not skewed in one industry or into one, two, or the Magnificent Seven here that could be the same in another international ETF strategy. But John, on that question, should I invest in those stocks directly? What international companies do we like? Do we see opportunity there, even though internationals had a big run this year after a decade of lagging? And I'll just let you answer instead of me continuing to ask the question.
Yeah, we invest in international stocks via ADRs or ADSs. These are things that trade on the U.S. exchanges. So they trade in dollars. Obviously, they are then subject to interest rate or currency risk, depending on how the foreign currency might do. So that's how we approach it. International investing is a little bit more of a different animal because you've got different accounting standards and getting data. Many of these companies don't report quarterly. They might report semi-annually, some even annually. So it's not as easy in my mind to find individual stocks. So, we have a handful of international stocks. I mentioned Total, the French energy company. TTE is the ticker symbol there. In the financial space, we like Allianz, the German company. ALIZY is the ticker. AXA, financial services. AXAHY is a ticker symbol. We own Siemens, which has done very well. Big German industrial company. SIEGY. So we do have exposure internationally via foreign companies, but we want them to have shares that trade in the U.S. Now, having said all of that, the world is small, and the businesses in which we invest, generally speaking, are global in nature. And so, Caterpillar is going to derive a substantial amount of income overseas. And so, we think you can get a lot of international exposure by investing in U.S. companies, but there's nothing wrong, again, and we have international strategies, nothing wrong, especially when you think about the divergence of valuation between maybe some of the U.S. stocks and some of the international markets. Now, some of that has closed because international markets have done very well. And so, we do, while we talked earlier about, we do look at our clients, big picture, help guide them on asset allocation. It's also important to note that many folks just use us for our equity strategy. And then some even use us for an international strategy. So we do offer these strategies independently. We don't require, 100% of our client assets in order to work with us. But we certainly like to help clients on the big picture, even if some of the assets aren't managed in-house. But we are wealth managers. But we also are asset managers when we have individual strategies, such as our dividend income strategy, if you like what you heard today, or our international strategies as well. So I think that there's ways to participate in all of the trends that are out there by investing in U.S. domiciled assets.
All right, this is going to be our last question, then I'll have a couple closing comments. But this one's going to take you longer than you have, so do your best. But we also, we pride ourselves on being transparent. And so through the market commentaries, we talk about our misses or our disappointments also. And so that was a great question we got. What triggers the sale of an underperforming stock in your portfolio? I.e., why did you sell Manpower when you did? So I know this can be a lot longer than a minute or two in response, but I think we want to make sure to address a question like this.
Yeah, well, it's a good question, and we had a lot of internal debate on our investment committee about Manpower. Manpower has been a chronic underperformer, and our belief is going forward that if they weren't able to do well in a relatively favorable environment, if we're heading into a more difficult economic situation, we're just not 100% confident that those dollars will deliver a high enough return, number one. Number two is that, and I'll give a little preview, we do have a report coming out on looking at the history of our stock picks. And it is fascinating. I think people's eyes will open why, when you look at even some of our biggest winners, like Apple, for example. Now, Apple has had since 1982, 55 bear markets, meaning it went down 20%. Amazon had 56 bear markets since it went public, including during the tech bubble where it lost 95% of its value. So no matter what and how great a company is, the stock price will have significant gyration. So there is no magic formula that says, well, it's gone through 17 bear markets, therefore we're not going to keep it anymore. It really comes down to us thinking, is there a better place for that capital? And can we still defend our thesis on a Manpower. And at this point, Manpower was a name that probably I was the leading champion of. If people know from these presentations in the past, it's been on here a lot. And eventually I came to the understanding that it just wasn't going to, at least in our opinion, provide enough of an upside potential here going forward over the next few years to justify continuing to hold, especially in a year where we've got significant gains on other stocks, and that we have significant opportunity to put those dollars to work in other equally or even more undervalued names. So it's
Yeah.
always for us about, is there something better for us to invest in? And
Yeah, that's something our clients and our readers right hear from us all the time. Every position is fighting for its existence in the portfolio, and sometimes that money we think is better used on maybe even bringing up some of these names that you see on the list, or there's just a better opportunity, even if it's been a great returner and a great performer for us, or if it's been an underperformer. Okay, so we're out of time. We went slightly over. I just want to touch on a couple of things real quick. Some of these questions that we didn't get to, we'll reach out. A few of them are individual questions. We'll reach out to you directly. Others, they'll be on the blog, and we'll address them on the answer on the prudentspeculator.com. If you are a client of ours, a wealth management client, if you are a subscriber, I'm going to encourage you, if you haven't looked around the Prudent Speculator website, to do so. We have a lot of additional reports around a comprehensive guide of private real estate, because we talk mainly about the diversification benefits here just around equities. And so we've got comprehensive guides of fixed income, alternative investments, private real estate that are just, I think, very informative. You'll also find, if you have next generation kids, grandkids, great grandkids, and you're wanting them to learn investing principles for the long term, we've created these, what we're calling wealth foundations. They're just one pagers, got about 3 bullets, a small paragraph, and a picture for that younger generation to start to introduce some of these long-term investing principles to them. They're great tools. You can use them, send them out to people. And then for those that had questions, again, about our wealth management strategies and services, you can email info@theprudentspeculator.com, or you can email jclark@kovitz, KOVITZ.com, or call me directly, 949-330-0901. We thank everybody for taking the time to join us today. And we thank you for the partnership for our clients and our subscribers. We appreciate the long-term relationship that we've had with you. And so thank you, John, for your time. Thanks for putting in the effort. And we hope everybody has a great rest of the week and has a great holiday season. Bye all.